Okay, let's dive into this. Welcome everyone to today's explainer. Now, if you've spent, any amount of time scrolling through social media lately, you've definitely seen it, right? The glamorous, high-speed world of day trading. It's always portrayed as this ultimate modern lifestyle. You buy and sell stocks in minutes, you secure these massive profits right from your phone, and boom, you're living life entirely on your own terms. And honestly, it looks incredibly exciting. But today, we're going to pull back the curtain on that flashy narrative. We're going to compare the myth of day trading with the undeniable reality. We'll break down exactly why most people who try it end up losing their hard-earned money and what you can do instead to actually build lasting wealth.
It's a super compelling question, isn't it? I mean, we've all seen those viral screenshots of just massive gains posted online. Someone buys a stock at breakfast, and by lunch, they're showing off thousands of dollars in pure profit. It really makes you wonder, is this truly a viable strategy for the average person? Is day trading genuinely the ultimate path to quick wealth? Or is it just a shiny trap designed to separate you from your cash? Well, let's look at what the data actually tells us about this high-octane environment.
Stripping away all the hype and those flashy social media posts, we really have to look at the foundational truth here. And the reality, as our source material pretty bluntly reveals, is that day trading is basically just gambling with extra steps. It's so incredibly easy to confuse looking at a complex stock chart with having an actual, predictable financial strategy. But the truth is, when you are flipping equities on a minute-by-minute or hour-by-hour basis, you aren't investing in a company's fundamental value. You're just placing a high-stakes bet on short-term, highly unpredictable price movements. Now, I want to slow down the pace for just a second to really let this brutal cold water statistic sink in. Studies consistently show that an overwhelming 80 to 95% of day traders lose money over time. Just let that sink in for a moment. Up to 95% of the people trying to do this are ultimately failing. Think about it. If any other business had a 95% failure rate, you'd run the other way. Yet millions of people are lured into day trading every single year, totally convinced that they are going to be the exception to this massive red slice of the pie. So what's really interesting here is exactly why that failure rate is so incredibly high. When you sit down at your laptop, you aren't just trading against another regular person in their living room. No way. This is a classic David versus Goliath mismatch. As a retail trader, you're operating with individual tools and limited funds. You're competing directly against the heavyweights. We're talking professional traders, highly sophisticated supercomputer algorithms, and massive financial institutions. They have infinitely deeper pockets, way better tools, and much faster information. You are essentially bringing a plastic spoon to a heavily armed, multi-billion-dollar financial battlefield. And beyond just those institutional disadvantages, there are 5 hidden dangers that most beginners simply do not see coming until it is entirely too late. We're looking at transaction costs, emotional decisions, the massive time sink, brutal tax implications, and the illusion of control. Let's break these down real quick.
Let's start with danger 1, high transaction costs.
This is often the silent killer of a new day trader's portfolio. It's not flashy, it's not dramatic, but man, it is mathematically devastating. See, every single time you execute a trade, there's a cost. Even if your brokerage advertises zero commission trades, you are still paying through what's called the spread, which is just the difference between the buying and selling price, along with various regulatory fees. When you're day trading, the sheer frequency of these transactions means these costs constantly, relentlessly chip away at your account balance. You might actually break even on your trades, but still end the day in the red because those commissions and fees literally ate your profits. Moving on to danger 2, emotional decisions. This one is all about the human element, and honestly, it's arguably where the absolute most damage is done. Our sources highlight that most day traders lose money not necessarily because they have bad analysis, but because of their own emotions. Human psychology completely betrays us in fast-moving markets. We fall into 2 massive traps, fear and greed. Fear causes you to panic sell the moment a stock dips, which usually locks in your losses right at the absolute bottom. Conversely, greed kicks in when you see a stock soaring. You get massive FOMO. You buy into an artificial market pump right at the very top, and then you just watch it crash moments later. You're fighting your own biology just as much as the market. Then we have danger 3, the time sink. This danger thoroughly shatters one of the biggest myths surrounding the whole day trading lifestyle. The fantasy is that you trade for what, an hour in the morning from a laptop on the beach, and then go enjoy your life, right? Well, the reality, You are glued to multiple glowing screens for hours on end, tracking every single micro movement. Day trading is a grueling, highly stressful full-time job. And because you're staring at charts all day, mental fatigue sets in rapidly. This burnout inevitably leads to poor, fatigued decision-making, which, you guessed it, generates massive financial losses.
Next up is Danger 4, taxes.
Taxes are an entirely unglamorous topic that most beginners completely ignore when they're dreaming about their massive profits. But here is the stark contrast. When you buy and sell a stock for a profit within a short period, typically under a year, those profits are hit with short-term capital gains taxes. The government taxes these gains as ordinary income, which sits at a much higher, punishing rate. On the flip side, the tax code is literally designed to reward long-term investors. If you hold an investment for the long haul, it gets taxed at the significantly lower, much more favorable long-term capital gains rate. So even when you do manage to win at day trading, you're taking home a much smaller piece of the pie.
And finally, Danger 5, the illusion of control. This is the ultimate psychological trap. It hooks beginners and keeps them coming back to the casino until they are entirely wiped out. The illusion of control works kind of like this. A beginner jumps into the market and, through sheer random chance or maybe a big overarching market pump, they win their first few trades. Suddenly, they feel like an absolute genius. They truly believe they've cracked the code of the financial system. They start increasing their risk, completely confusing a lucky market condition with actual, repeatable skill. And then, the inevitable reality hits. The market shifts, their luck runs out, and because they were wildly overconfident, they lose everything they made, plus a whole lot more.
So the crucial point is, what is the winning alternative?
If day trading is basically a rigged game stacked heavily against the average person, how do you actually grow your money? Well, our sources present us with a very clear, highly effective, and entirely actionable long-term playbook. It boils down to 3 simple steps. Step 1, buy broad market low-cost index funds, like those tracking the S&P 500. Step 2, invest consistently over time, whether the market is having a good day or a bad day. And step 3, which is absolutely the most important one, let time and the mathematical magic of compound interest do the heavy lifting for you. You don't need to stare at charts or fight algorithms. You just need to participate in the overall long-term growth of the economy. And this brilliantly illustrates the difference between these two approaches, which is literally night and day. On one side, you have day trading, high stress, immense risk, terrible odds of success, and brutal taxes. On the other side, you have index funds, incredibly low stress, significantly lower risk, and historically, far, far better financial results for the average person. It's the classic tortoise and the hare scenario, but in this case, the tortoise gets to keep all their money and their sanity. The overarching takeaway from our source material is perfectly summarized by a really simple truth. The smartest investors play the long game. True wealth isn't built in a frantic afternoon of staring at candlestick charts and praying for a price bump. It's built steadily, quietly, and persistently over years and decades. It's about leveraging patience rather than relying on adrenaline. So, as we wrap up today's explainer, I want to leave you with a question to consider regarding your own financial strategy. Knowing the steep disadvantages, the brutal failure rate, and the heavy emotional toll, will you choose to gamble against the algorithms? Or will you take the proven path, step away from the screens, and let time do the heavy lifting for you? The choice is entirely yours. Keep learning, keep growing, and I'll see you in the next explainer.